Okay, let's unpack this.
Let's do it.
We're doing a deep dive today into the Williams Companies, Inc. Williams.
Right, the energy infrastructure giant. And they are definitely in what looks like hyper-growth mode right now.
Yeah, our mission here is to really look at their Q3 2025 results, but also, crucially, their latest combined 10Q filing.
Which covers Williams itself, plus Transco and Northwest Pipeline, or NWP. We want to piece together the strategy behind this, well, frankly, massive capital allocation.
It's not just numbers on a page, is it?
No, not at all. Think of it as a blueprint for maybe the next decade of how energy moves around the U.S.
And we're seeing some aggressive moves. Billions of dollars. We really want to highlight for you this pivot they seem to be making.
Here's what you might call next-gen energy demand.
Exactly. LNG export is a big part of it, obviously, but also, and this maybe surprised me a bit, power generation specifically for data centers.
That's definitely a newer angle getting a lot of focus. So by the time we're done here, you should have a clearer picture of their acquisitions, the logic behind them.
And just the sheer physical size of these pipeline projects they're undertaking.
And really understand why they seem so confident betting on the long-term future of natural gas.
Okay, so let's start where these things always start. The money. How are they funding all this?
Well, the foundation looks pretty solid. Q3 2025 results were strong.
Right. I saw net income attributable to Williams was up, what, $145 million compared to last year?
Yeah, and service revenues climbed 9% year-to-date through Q3, so the cash flow is there. They seem to have the cushion to back these big ambitions.
Which they absolutely need, because the headline number, the capital expenditure forecast for 2025, is huge.
It really is. We're talking a range of $3.95 billion to $4.25 billion. Let's just use the midpoint, call it $4.1 billion.
And get this, that $4.1 billion, that excludes acquisitions, right? That's just project spending.
Correct. Solely for projects, which, $4.1 billion in 1 year, that's massive.
It really is. But looking at how they're planning to spend it,
yeah,
that tells a story in itself, doesn't it, about their priorities?
It absolutely does. The vast, vast majority of that $4.1 billion, it's earmarked as growth-focused.
Meaning driving long-term volumes, long-term revenue.
Exactly. So you see major dollars aimed at that LA LNG investment we mentioned. New on-site natural gas and power generation projects, those are the power innovation ones.
Right, the data center links.
Yes. And then significant expansions in gathering and processing, like the Louisiana Energy Gateway, they call it LEG.
Okay, so if $4.1 billion is going towards growth, building new stuff, what's left for just, keeping the existing pipes running smoothly?
Well, that's where you see the strategic choice, maybe the tension.
How so?
They're projecting only about $700 million for maintenance capital. That's for asset integrity, keeping things safe and operational.
Okay, $700 million.
And modernization.
Even less. Just $150 million planned for modernization and what they call ERP2 capital. That covers IT system upgrades, some emissions reduction tech, things like that.
So the ratio is pretty stark. It feels like they're betting the farm on building new capacity for future demand. That seems to be the signal, yes. The highest return, in their view, clearly comes from expansion right now, even if it means, focusing less capital proportionally on maintaining or modernizing the existing base today. It's a big bet on natural gas staying central for a long time.
And it feels like they're not just waiting for demand, they're actively trying to build and capture it. Which brings us to the acquisitions.
Yes. This is where it gets really interesting.
Since January 2024, there's been this, flurry of deals, big ones, really reshaping their footprint.
They've essentially been buying strategic puzzle pieces, access points. It kicked off big time back in January 2024.
That was the Gulf Coast storage deal.
That's the one, $1.95 billion. Snapped up key storage facilities, pipelines in Louisiana, Mississippi. They just paid off the final $100 million deferred payment on that this past January 2025.
So securing storage was step one. Then it looks like consolidation was next.
Seems that way. In August 2024, they spent $170 million to buy the remaining 40% they didn't own in Discovery.
Giving them full control.
Exactly, full consolidation. And interestingly, just by doing that, they recognized a $127 million gain on paper just from remeasuring their existing stake to fair value.
Wow, okay. That's a nice accounting win.
Definitely. Then fast forward a few months to November 2024, they paid $307 million cash for Crowheart.
That was Wyoming, right? Wamsutter.
Yes, consolidating their upstream interests in the Wamsutter field, streamlining things in a key supply basin.
And the buying didn't stop there. It rolled right into 2025, targeting specific production areas.
That's right. January 2025 saw the Rimrock asset purchase. That expanded their gathering and processing, their GMP in the DJ Basin.
Okay.
Then in June 2025, they bought the Sabre assets. That was a big move to expand significantly in the Haynesville Shale.
Which is critical, right? That low-cost gas supply everyone wants access to.
Absolutely vital for feeding LNG and other demand centers efficiently.
Okay, before we jump fully into pipelines, there was one other investment, an equity stake that really signals that downstream power play.
You mean Cogentrix?
Yeah, tell us about that.
Yeah. So March 2025, they made a $153 million equity investment into Cogentrix. This gives Williams a minority piece of a fund that owns 11 natural gas power plants.
And they categorize that under their marketing services segment.
They do. It's essentially Williams forging a direct link, connecting their gas supply and transport capabilities right into the power generation market.
Connecting supply to demand, which is exactly what the huge LNG deal announced in October is all about, isn't it? This came after the Q3 report, a subsequent event.
A very significant subsequent event. That $378 million initial purchase price is just the start.
So what did they get for that?
It's a major play in vertical integration. They bought a 10% equity stake in Louisiana LNG LLC. That's the entity developing a permitted LNG export facility.
Okay, 10% equity.
Yeah.
But there was more, right? The pipeline piece seems key.
Arguably the more valuable piece, operationally speaking. They also acquired an 80% controlling interest in Driftwood Pipeline LLC.
And that's a brand new pipeline.
Greenfield. Fully permitted greenfield pipeline, yes. Designed specifically to feed the Louisiana LNG facility.
So Williams isn't just investing passively here. They're taking the reins on the infrastructure.
Absolutely. Get this. Williams is the operator of the Driftwood Pipeline. They'll manage the upstream gas supply for the LNG plant.
Wow.
And they've secured rights to purchase some of the LNG produced. It creates this powerful synergy loop.
Control the gas, transport the gas, profit from the export, profit from operating the pipe.
That's the idea, a very tight integration.
Okay, let's shift gears from the deals, the acquisitions, to the actual physical expansion. The pipes in the ground.
Right, the projects. And the scale here is, well, it's something else.
What came online just in 2025?
It's been a busy year. Transco, their main East Coast artery, put several big capacity boosts into service.
Like what?
April 2025, you had the Texas to Louisiana Energy Pathway. That added 364,000 decatherms per day, MTT.
Okay, and a decatherm is roughly 1,000 cubic feet of gas, for context.
Roughly, yeah. Also in April, the Southeast Energy Connector came online, adding another 150 MUD-FD. And then in October, the Alabama-Georgia Connector added 64 MUD-FD.
So steady additions on Transco. But the really big volume jump seemed to be in the Gulf Coast, connecting to that Haynesville supply they bought into.
Precisely. The Louisiana Energy Gateway, LEG. That project was fully placed into service around mid-2025. The result? A massive 1.8 billion cubic feet per day, BCFD, increase in gathering capacity.
1.8 BCFD, just from that one project system.
Directly tying that prolific Haynesville gas into their network. And offshore wasn't quiet either. They completed the Deepwater Shenandoah project in July.
Linking offshore production to onshore processing in Louisiana.
Right, at LaRose, Louisiana. And earlier in the year, January, the Deepwater Whale project expanded their offshore gas and oil transport capabilities too.
Okay, so a lot already done in 2025. But the future capacity additions, that's where the numbers get even more staggering. And it ties right back to that data center strategy.
It really does. Williams has locked in agreements for 2 additional power innovation projects.
Which involve building
Both new power generation facilities and the dedicated natural gas pipeline infrastructure needed to feed them.
And crucially, these are backed by long-term contracts.
Yes, this is key. 10-year, fixed-price power purchase agreements, PPAs, likely with major data center operators.
That stability must be incredibly attractive, right? Compared to maybe more volatile commodity gas prices.
It's extremely attractive. Think about it. Data centers run 204/7. They need reliable power. Locking in a 10-year fixed price, that's a predictable, high-margin revenue stream, very different from traditional midstream swings.
When are those projects expected?
Expected in service during the first half of 2027, so not too far off.
Okay, data centers are one piece, but the traditional pipeline expansion, just moving gas to markets, that's still huge in their plans.
Oh, absolutely dominant. Look at the Transco expansions plan, the Southeast Supply Enhancement Project.
That number jumped out at me.
As it should. It's projected to add a breathtaking 1,597 millitat of capacity.
So nearly 1.6 BCF per day in new capacity.
Yes. Aiming for Q3 2027 in service. And importantly, it's fully contracted already. Demand is locked in.
And they haven't given up on the Northeast, despite the challenges up there.
Still pushing hard. The certificate for the Northeast Supply Enhancement Project was actually reissued in August 2025.
That adds how much?
About 400 ME safety. Also fully subscribed. They're targeting Q4 2027 for that one, but it hinges on getting key permits, especially in New York and New Jersey. That's always the hurdle there.
So you add all this up. They're building this massive new capacity on top of an already enormous system.
That's the context you need. The Transco system already feeds LNG export projects totaling a colossal 17.8 BCFD. This new capacity bolts onto that existing export backbone.
Which forces the question, right? How does this level of aggressive expansion, this deep commitment to fossil fuels, square with their own stated environmental goals?
Yeah.
And how are they handling the regulators?
It's the core tension, isn't it? They do have defined targets. Near term, a 30% cut in carbon intensity by 2028 using 2018 as the baseline.
Okay, intensity reduction.
Yes. And long term, the ambition is net zero emissions by 2050. These are serious public commitments running alongside this massive gas infrastructure build-out.
Okay, so they state the goals. What about navigating the immediate regulatory landscape?
Yeah.
The 10Q mentioned the Transco rate case.
Right. Transco filed that general rate case back in August 2024. Good news for them, relatively speaking. During Q3 2025, they reached an agreement in principle with customers and other parties to settle it.
Why is that significant?
Stability. Settling the rates provides revenue predictability for Transco for the next few years, removes a big question mark.
What about that litigation, the Atlantic Sunrise project? That sounded potentially costly.
It was a significant issue. In February 2025, Transco got hit with an adverse judgment related to construction services. The total award estimate was around $110 million.
Ouch.
Yeah, but they seem to be managing the risk. They state in the filing that they expect the probable loss will actually be substantially less than that headline number. And crucially, they expect to recover about 29% of whatever they do end up paying from the project's co-owner, so they can pass on some of that hit.
Risk sharing, vital. And lastly, there was that specific example of climate policy hitting the bottom line, Northwest Pipeline in Washington state.
Exactly. A perfect illustration. Under Washington's Climate Commitment Act, NWP now has to buy carbon allowances for, I think it was 9 of its 13 compressor stations in the state.
So a direct operating cost imposed by regulation.
Yes. But here's the business model aspect. Their rate structure, likely due to a prior settlement, allows them to recover these costs. They expect to get the money back through rates in their next regulatory filing.
So the cost gets passed through, maintaining their revenue stability despite the environmental charge.
That appears to be the mechanism, yes.
Okay, so despite all this spending, billions on growth, navigating lawsuits, dealing with new climate costs, their credit ratings look solid.
They do. Investment grade across the board. S&P has them at BBB plus stable, Moody's at Bet2 positive, and Fitch at BBB positive.
Maintaining that status must be a huge priority.
Absolutely critical. There is one specific risk noted, a contingency worth mentioning.
What's that?
If, for some reason, their credit rating did drop below investment grade, certain contracts would kick in, requiring Williams to post about $12 million in collateral.
Okay, so a manageable number, but something they definitely want to avoid triggering. A key liquidity thing to watch.
Exactly. Keep that investment grade rating.
So let's try to pull this all together. What does it all mean?
Well, we've seen a picture, haven't we? A major infrastructure company, Williams, putting its capital very aggressively towards long-term growth.
And the strategy seems pretty clear now. Use acquisitions strategically to consolidate control in key supply areas like the Haynesville.
Right. And then build massive new pipeline capacity to connect that supply directly to what they see as the big growth markets.
Which are increasingly LNG export.
And this newer, very stable demand from power generation, specifically for data centers.
It really feels like a company doubling down, betting very confidently that natural gas is going to be central to the energy mix for decades to come.
And they're building the physical infrastructure. I mean, that 1.6 BCFD Southeast supply enhancement is proof positive to make sure they own the critical pathways for moving that gas.
So you should now have a really solid understanding of the scale of this commitment, this expansion of their natural gas footprint.
That's enormous.
Which leads us to the final thought, the question to leave you with. Given this immense pipeline capacity being built right now, capacity that's already fully subscribed, locked in.
And coupling that with their stated long-term goal, their ambition to reach net zero greenhouse gas emissions by 2050.
The big question becomes, What kind of disruptive change, what innovation? Maybe it's carbon capture at scale, maybe it's hydrogen blending in the pipes, maybe something totally unforeseen what has to happen over the next, say, 2 decades.
To allow all this expanded natural gas infrastructure to actually remain utilized, to stay profitable.
While also somehow meeting those really aggressive environmental targets. It feels like the ultimate balancing act of this energy transition, doesn't it?
It really does. How do you reconcile building for today's demand with planning for tomorrow's climate goals? That's the multi-trillion-dollar question.